Hello, everyone. Today we're going to talk about employee stock purchase plans, or ESPPs, as everyone else refers to them to. We're going to be talking about what they are, how they work, what are some tax considerations we need to worry about, and then maybe going to go through a couple planning techniques to see how to maximize the value of your plans. So Derek Mazzarella with Gateway Financial Planning Partners. Let's get after it. All right. So what are they? Basically, employee stock purchase plans are an additional form of compensation for employees. They allow you to buy the company's stock, typically at a discount. So there's kind of a range. Okay, so let's look at a few of the provisions of it. So the first thing is typically going to let you do between 1% and 15% of your salary to contribute towards a plan. And then generally the term, how are they going to configure this? So they're usually going to go. Most common one is 6 months pieces where you can buy the stock through your payroll deduction in 6 months increments. But some will go from 3 to 24 months. So they will tend to vary a little bit, but most will do January 1, great handwriting here, until June 30th, right? And then July 1st to December 31st. So they'll look at the window and say, okay, what's the stock price there? Whatever it is, you'll buy it at a 15% discount. Now, some plans will actually have a look back period. So let's use this awesome chart here as an example. If on June 30th, let's say the stock goes up to here, right? So most times you're going to have two buying points. What was the price at the beginning, or what was the price at the end? And most plans, not all of them, but most plans will let you buy in the lower of the dollar amount. So let's say this one's at 100 and this price is at 85. You'll get 15% discount on the 85. So it's a pretty cool feature. So even though the stock is currently worth $100 today, you're getting a 15% discount off the 85. So that's already a pretty nice return to worry about. So they can be pretty valuable when it comes to adding wealth and having a good strategy around it. So that's really the biggest benefit. And the other thing to look at is you do get a 15% discount, but your return is actually 17.64% if you were to sell it right away. And this can get a little bit later on how it works, but here's the math on that. So let's say I do have the stock. It's worth $100 now. I'm going to get the 15% discount, so I could buy it at $85. So I'm basically making $15 a share. But the math on that is not just saying, hey, I returned 15%. The real math is, look, I've made 15. I had to put 85 into it. So 15 divided by 85 is 17.64%. So that's a great return. I would take that all day. Typically, most stocks in the S&P has averaged between 8 and 10% per year on average. So you're already doing much better than the S&P 500 without doing any work, provided you sell it right away. Okay, sounds wonderful. What are some of the gotchas with the ESPP plan? So first thing you have to do is consider the taxes. Okay, right? So if you buy the stock and then sell it right away, you're going to pay income tax rates. And that's because you held the stock for less than 1 year. Now, if you hold the stock for greater than a year, you're going to pay capital gains rates, which is either 0, 15%, or 20%. Draw. So depending on how long you hold the stock for, there's going to be some tax considerations there. The second thing to worry about is, okay, let's say you're just buying the stock, you're accumulating it. You have a lot of stock risk there, right? Because if you own a lot of company stock, you're going to have a decent amount of risk involved, because if the company does really well, that's great. Like Amazon for the longest time, historically has done really well. But let's say you get another stock like General Electric, for example. Morningstar rated them as one of the worst stocks of the last 10 years. So, if you're keeping some of those stocks for the long haul, you could actually be losing value, because let's say you did buy it at the stock was worth 100 when you bought it. You bought it for $85, but now the stock's worth 30. That's not a great deal for you, right? So that's one thing you need to worry about, is making sure you don't have too much of your assets in one company's stock. Okay, so let's talk about, how can we actually maximize the returns from your ESPP program? And there are a couple of things you could do. So one is you engage in the process, right? So you buy your stock at the 6 month intervals. Let's say that's part of your plan. Get the 15% discount, and then sell right away. Just sell all of it. You pay the tax on it. I know it sucks, but get your 17.64% return right away. And then you kind of immediately take the proceeds after taxes and then invest it again. So let's say you invest in either the S&P 500 or a more diverse portfolio. So now you're taking a stock, you're getting extra leverage on that because you bought it at a discount. So, you're spending a lot less to get a little bit more. And then now you're throwing that extra amount consistently every 6 months or so into the S&P 500, or probably most likely a more diverse portfolio. And now your returns have done even better than, either the S&P or diverse portfolio would have, because you're pushing extra money into that. Alternatively, if let's say you are on the, hey, I really believe in my company stock, I think it's going through the roof. One of the ways you can mitigate that is maybe just sell half or sell a third of it, to just mitigate the risk over time, because you will be building up a good amount of stock. And typically, if you're getting access to an ESPP program, you're probably most likely also getting corporate stock through restricted stock units or other stock options you're available to buy. So a lot of compensation goes into your company stock, especially as you climb up the corporate ladder. So it is good to try and diversify that away. But just locking in those gains and on a consistent basis removes the emotion from it. Because the other problem I see with a lot of clients with these types of company stocks is to get really tied emotionally to the company. Hey, I know we're having a down year right now, but corporate's telling us the stock's going to rebound because we got XYZ things coming down the pike, and the stock just keeps ticking down and down and down. So when you are able to buy, sell it immediately or sell it shortly after, and then have another plan to reinvest it elsewhere, that can help mitigate a lot of your risks. So when it comes in ESPP program, I think they're great. You look at each individual situation, make sure you understand your individual plan, because they can vary quite dramatically between companies. So you really want to make sure know exactly what you're getting into, how you're buying it, and how you're getting out of the company stock. So I'm Derek Mazzarella with Gateway Financial Partners. Hope you enjoy this talk.